What's up, everyone? It's Karthik with MoneyVest. I am absolutely exhausted, as I'm sure you are as well. This has been a very, very wild week, and the day is finally over. The markets are finally closed for the week. So this is going to be the final update for the week. Of course, we did see a little bit of a rebound to continue after a very strong rally from yesterday. So we had the NASDAQ pushing up over 0.5%. It's been a little bit of a chop fest the entire day. We were up, down, all over the place. I'm going to break down the QQQ's overall trend, the S&P 500's overall trend as well, and whether we are now in an official uptrend or not. We'll discuss all of that. S&P 500 up almost 0.5%, and the Dow Jones pushing up over 13 basis points. The yields also coming down a little bit. We did have TLT and TMF continue to push higher. So there was a bit more broadening of the entire market. Equities, bonds, everything getting a lot of liquidity on the day, and of course pushing higher. So as always, if you enjoyed this video, please make sure that you drop a like and subscribe to the channel. We had a very, very busy week. So last 7 days, I am happy to announce that we had over 225,000 views on the channel. That was up over 190% from the previous week. And we had over 26,700 watch hours, which was another up 124% from the previous week. And subscribers, we also gained over 1,700 subscribers. So thank you so much for subscribing. I would really appreciate that if you share these videos and share the analysis that you're watching on this channel. If you're enjoying the content, if you're finding it helpful and valuable, please do share this, because it's really recommendations and word of mouth like this that helps us grow this channel. And I'm actually not happy because we did have, the subscribed to not subscribed ratio is very, very high. So a lot of you guys are watching but are not subscribing. In fact, 40% of you are not subscribing in the last 7 days. So, I've got the data right here to call you out. So please do subscribe. I would really, really appreciate that. Helps this channel grow tremendously. So this right here, again, was the state of the market. I actually closed out my covered call on Tesla, up almost 95%. And I'm actually planning on closing out the trade on FNGU as well. I'm going to let it run a little bit longer. But this right here is what I posted on my Instagram. Make sure to follow me there as well. Handle is going to be CastWRP 7/31. So July 31st is when I actually first sent out the alert for FNGU, and that I was planning to buy it. Monday, of course, I picked up majority of my shares, and this right here is my current position. And I also mentioned that, honestly, the plan was to actually buy a lot more aggressively and be more heavy on this position, but we rebounded fairly quickly with the volatility crush coming in, which I'm going to go over later in this video. The technical rebound, and up just over 6.5% in 1 week, so not too shabby, breaking out to over $1,000 in profit in the last 5 days. So this position, I will be looking to close this out, and this was strictly built on the idea of Magnificent 7 stock. So this right here is the Magnificent Index that we have created on TradingView, and what you'll notice is that it was in a very nice little uptrend from since the July 2023. So this right here, we sold off. We then pushed higher. You'll notice that we consistently pushed up, getting down here, and then of course hitting an all-time high here at over 2,000. Then this right here was the sell-off that we witnessed down to this higher low. And that was Monday morning. As you'll notice that, of course, we saw pre-market on Monday morning, a lot of volatility spiking to over 65. RSI, MACD, L3 banker oscillator, aggressive amounts of selling pressure. So I did pick up a lot in the Monday morning market open. So majority of my buying I did during Monday, and then I picked up some more shares on Wednesday, and only really deployed about 15 to 20% of the available cash that I had for this pullback or a correction, because we still are very much within the context of a pullback at the moment. So if you come over to the market snapshot, you'll notice that the Dow Jones is now in a dip. It's only down less than 5% from its all-time highs. We've got the NASDAQ still in a correction, but barely. So you'll notice that just by 10.26%. And the S&P 500 is also still in a pullback by only 86 basis points. So the moment it's within 5% of its all-time highs, we're going to move back into a dip category. And NASDAQ also very close to moving from a correction over to a pullback after the recent run-up we've seen over the last couple days. Meta is one of the first Magnificent 7 companies to move back into a dip territory. It was down to a pullback in down over 9-10%. And it actually never really went into a correction. That, I think, is very interesting for Meta, because it was always in a bit of a pullback. Or maybe it did. I think maybe it did earlier this week. Very, very briefly, it dipped into a correction and then, of course, moved back into a pullback. And now it is well within 5% of its all-time highs. Apple is only down less than 9%. So in a pullback again, Amazon over 17% down from all-time highs in a correction. Microsoft in a correction. Nvidia is in a bear market. Tesla, unfortunately, still in a bit of a crash, down over 51% from its all-time highs. So all of this is actually going to be available on our MoneyVest platform. As you can see, that this is a platform that we have built on our channel at MoneyVest, so you can access all of this and of course do your full comprehensive analysis, fundamental analysis on over 17,000 stocks. We're going to be including ETFs in the future, as well as your entire portfolio dashboard to calculate risk, your beta, Sharpe ratio, risk adjusted returns. Everything's going to be available on the platform eventually, so link's going to be down below. So this right here was the trade, and again, we're going over a lot of data, right? So this is what this channel is all about. We're looking at historical data to really extrapolate some of the more important information, cut out all the noise, and really depend on statistics to guide our decisions. And this right here is the Magnificent 7 index that we created, and that's the data that I just showed you. And what you'll notice is that we are still in a bit of a correction, down over 10 to as much as 20%, so within 10 to 20% from all-time highs. And there's nothing wrong with that, because that's where we are. But as we are moving higher and higher, we're going to go from a correction to a pullback to then back into a dip within 5% from its all-time highs, and of course eventually getting up to all-time highs as well. But really what I wanted to address here in this video for Magnificent 7 is the drawdown after we have achieved a correction, which we did. For Magnificent 7, at one point we were down over 10% from all-time highs. So every time, and again, this data goes back as far as 2014, so over 10 years, every time we have dipped into a correction, meaning that we're down over 10% from all-time highs, that correction has accelerated to somewhere between 19 and as much as 23% on an average and median basis. So knowing this information, knowing that you know that every time this index drops over 10% from all-time highs, it is most likely to accelerate down over 19 or 23%. And now, if you come over to this is the index itself, and take a look at how much we were down on Monday morning. From all-time highs of 2032, we were down at one point a little bit over 20%. So how crazy is that? We were down exactly 20%, a little bit over 20% between the 19 to 23% threshold. So we were right there in the middle of these two values, and that was probably one of the best timings. Again, we're not here to time the market, but that was probably one of the best timings to dollar cost average, be more aggressive at those levels, because not only the index itself, again, if you're trading Magnificent 7 stocks or collective aggregated indexes on Mag 7, that wasn't just the opportunity to buy from a Mag 7 standpoint, but it was also an opportunity to buy because of volatility hitting highs of over 65, right? The third highest level we've seen in over 33 years. So it's data like this that becomes very useful, and because we're not going to find a huge buying window here. I jokingly mentioned in our Discord today, thank you Volatility for giving us a 60-minute buying window on a Monday morning pre-market, and that's cool. Like I will not forget this. And I was just kind of jokingly saying that because it was short, it was very brief. If you didn't take advantage on Monday morning, or did some buying on Tuesday or any time earlier this week, you really did miss out on some serious gains. And that's why I think it's really important to not wait for the markets to get down lower. Once the risk reward is there, once it starts putting up some nice opportunities, take advantage. Even if it's a little bit, take advantage. Do not wait. Do not wait for the perfect opportunity, because that perfect opportunity that you're looking for will just never come. So take advantage. And Volatility here, like I said, it's kind of hard to believe that just 5 days ago, this number was at 65, at 180% higher than where it's right now, and it's back down to 20. Back down to 20, folks. I mean, that is just an incredible amount of crush in volatility. And this is a little bit more of an appropriate value to begin with because of the volatility cheat sheet that I've shared in my previous videos, because the markets are only down less than 6%. So volatility does not deserve to be well in the 30s or 40s. I mean, 20 is more than appropriate for the volatility and where it's at, given the S&P 500 drawdown from all-time highs. Now, this right here is where we are for the S&P 500. So this is the current level for SPX, and the reason being is because we're still down over 5% from all-time highs, but well within 10% of all-time highs. So we are still in a bit of a pullback on the S&P, as I showed you, and this is where we have been majority of the times. For over 56% of the times, this is exactly where the markets have been in the past as well. We were close to a correction, so that would have been over 78%, or majority of the time spent within 20% of all-time highs, but we didn't quite get down to a correction. We were only down, I think, over 9% from all-time highs. This right here is the current valuation on the S&P 500. This is also something that we have to track on a regular basis. So after the recovery that we have seen, we are now at around 21.8, so just a little bit under 22 times earnings multiple on the S&P 500 based on 2024 numbers, and based on a 5-year, a 10-year, 20-year, and a 30-year average, we are, some people would argue that we are overvalued or expensive based on those historical averages, anywhere from 0.5% to as much as 18% on the S&P 500's valuation. Again, I'll let you be the judge on where you feel is the appropriate valuation, but we are in the 89th percentile going back over 60 plus years for S&P 500's valuation. So 89th percentile puts us somewhere between here. So we are in a little bit of the higher zone. But the moment we get up to over 95 percentile, that's going to be a pure signal for me to stop all buying, seize all, buying on trading on the long side, and really just be very careful and cautious because the market's going to be trading well above 27, 28 times earnings multiple. So if you do see that multiple expand on the back of an increasing price, that's going to be, once again, that signal indicator for me to seize all buying, take all the long trades off the table, because at that point we're going to be trading at pretty expensive valuations, not to mention technically would also be pretty overbought. Coming over to unemployment and jobless claims, this is also something that I broke down in my other video, and this is where the current situation is with both unemployment and jobless claims. Jobless claims numbers came out yesterday. A lot of people were mentioning that unemployment last week was pretty brutal. 4.3%, we're accelerating higher, which we are. But if you really just look at statistics and data based on historical readings, this is going back as far as 1948, we're still well within range. 22 percentile is where we are. And if you take a look at historical numbers, 22 percentile is still within the context of this, which is really, really low from a historical measure. When it comes to jobless claims, we just printed 233,000 for last week. And this right here is 17 percentile. That's where we are. And you'll notice that we're somewhere between these two numbers. We still have a long way to go in order for us to maybe have any expectations of a recession. We have a long way to go. These numbers have to accelerate much higher, well in the 400,000s for jobless claims, and for unemployment to, of course, push well above 6 to 7% in order for the U.S. economy to trigger a recession. And of course, the Federal Reserve to step in and intervene. We've discussed all of that in our previous videos with regards to rate cycles, recession cycles, and the market cycles as well. So make sure that you do watch those videos as well. Those are super helpful. It's really going over a lot of data that you don't want to miss out on, and really just try to understand and have a overview of where we are with this current market cycle. Now, talking about volatility. We didn't really get a lot of buying. The buying window was there, but it wasn't there for a long time. We really got crushed back down to 20.6 very, very quickly, as I mentioned earlier. We're now in the 64th percentile. We're back in the normal zone. This number was extremely rare on Monday because we were well above 70. We were well over 65, so we were in the 99 percentile. I remember watching this number on Monday morning. We were at 99.15 percentile, which was, again, very, very high, and that turns green. It starts flashing green. Why? Because green is for us to buy. That's a color code that's for me is a buying opportunity. If it's red down here, that means volatility is extremely low. It's coming down to single-digit percentiles or under 10, under 12 percentiles, and that's a signal for me to remain cautious, be careful, be alert, not trade on the long side, not be super aggressive in my buying. But the opposite is also true for me here. When volatility is extremely high, it is time to buy stocks. So we are now back down to 64 percentile, more in the normal zone, and 20 is going to put somewhere over here. It's actually going to be now somewhere between these two numbers. So that's where we are. Coming over to the market. So again, overall, broadly speaking, we did have the markets push up. Majority of the stocks were advancing on the day, with a few small pockets like Intel, Texas Instruments, Advanced Micro Devices, Nvidia was slightly down. UNH, we got AbbVie, Amgen, Pfizer. So mostly healthcare, biotech, and semis, and a little bit of industrials and maybe materials and household names and staples were selling off, but mostly the money flew into SaaS and technology and Max 7, pushing higher. And this right here were the ETFs. Again, broadly speaking, there was greenery across the board. All sectors were green today, except for industrials that were slightly down, basically flat. In the last 1 week, we do still have materials, utilities, and defensives pushing downward, and technology with a huge rebound, pushing up over 88 basis points on the week here, despite starting off the week really, really badly. And then we had the Last month, 1 month performance, technology and cyclicals and comm services, 3 of the worst performing sectors still, and real estate, utilities, and defensives are still up in the last 1 week. So market's performance definitely does suggest that over the last 1 month, we are still very defensive. But that trend, of course, has changed in the last 2 to 3 days. I mean, this week, we started off really bad for technology, for, again, growth stocks and SaaS stocks and cyclicals and comm services, but of course recovered over the last few days here. Bitcoin also back over 60,000 and Ether just under 2,600 as well. This right here is where the VIX futures term structure is. I mentioned this in our Discord, and people were asking if we're going to see volatility spike back up. Is the buying window over? And the unfortunate answer is that the markets are not really pricing for another volatility spike anytime soon. So what you'll notice is the next 9 months worth of contracts here on this term structure. And what we like to look at is contango versus backwardation. We are in contango towards the back half of this term structure. So anything that is beyond December, in volatility pricing all the way through March of next year, we are seeing prices increase as we go further out in time, and that is in contango. But we are seeing backwardation in October, November, and December contracts. So this right here is the backwardation that we're witnessing, and there is, of course, the first 2 contracts also in backwardation. So we'll be looking at August contract to dip below the September contract, and ideally what we want to see is, of course, all these prices are going to move to the spot VIX on expiration. Volatility here as a 20.31, and that's really where the October is priced, around 20.5. So it's going to move to the spot VIX, of course, eventually as it gets closer to expiration. But the idea here is that we've got, backwardation, contango, backwardation, and the back half of the curve is still very much in contango. So, and again, the difference has also come down to just over 3% between the first 2 contracts. So that's where we are. Again, volatility is not priced to spike anytime soon. We're back into a more muted market here in terms of volatility, and of course the S&P 500 and the NASDAQ. And because of that negative correlation, it's expected for the markets to continue to perform well if volatility continues to drop further down. Now, moving over to the technicals and starting with QQQs, something that you have been waiting for. By the way, S&P MoneyVest Index back over to 3.3, so we did get a little bit of a rebound. And as I pointed out in my previous videos, the last serious buying opportunity that we had was back in April of 2024. So this right here, April 20, so 420, I still remember that. I did a video on the shopping list back then, and that was 420, 2024. And the next serious buying opportunity I can easily say was Monday. That was 8/5/2024. Both times you kind of hit that lower bound at 3 on the MoneyVest Index. It didn't really dip below the green sort of zone. We did very briefly on Monday morning when I calculated the MoneyVest Index. We were at 2.85, so we were around here. That's why I did some buying. But then, of course, we quickly recovered, and that's where we closed. We closed above 3 for the end of the day because we did see a nice recovery intraday. Prior to April 2024, I can easily say that we were back in October of 2023 as a nice buying opportunity. In fact, a very, very good buying opportunity because at the time, the MoneyVest Index was trading down to 2.4, which was even lower than what we have seen in the last couple times. So that's where we are with the MoneyVest Index at the moment, back over 3.3. Now, coming over to QQQs first, going over to the 30-minute time frame, and what we discussed in our yesterday's video is the idea that we're still within the context of a downtrend of lower highs and lower lows. As you can see, that we are still making this lower high and this lower low pattern that still remains. However, we started printing a higher low yesterday, and then today we got a little bit of a breakout above the 449, 450 level. So you see that big candle that came in at 1 p.m. Eastern. I'm assuming the volume was also really high at that point. If I bring up the volume bar. So not super high, but we did get a nice little breakout above 449, 450, traded all the way up to 451, and then of course consolidated sideways. So we're going to go ahead and turn this level into a new support for QQQs, and this right here now can be considered as a bit of a higher high for QQQs. So we are now indeed, for the first time since the sell-off has begun, making a bit of a higher high for QQQs here. So that's going to be the markings for what I'm labeling out here, 1 and 2. And in terms of a higher low, we've already mentioned this as being a higher low, and this right here was of course the bottom for the market on Monday. So in a bit of a context of a higher high and higher low now. So that's good to see. That is a healthy potential uptrending market. But we still have to be a bit more cautious. We need to see more volume, more follow-throughs from this uptrend for this to be confirmed. And the next target, the next resistance that QQQs are going to be targeting now is going to be all the way up to 467. And that is going to be, I believe, just over 1% away. Actually, a little bit over 4% away from where we are at the moment. But that is going to be that next target of just over $467, $468 for QQQs. I'm still not fully convinced. I'm going to be honest that yes, technically speaking, we are making some higher highs and higher lows, but I'm not fully convinced that this is going to be able to retarget back up to 467, 468. I mean, we still do have a little bit over 4% left for it to regain up to that level, but I'm still not fully convinced. I'm like there, almost there, but I'm not fully there. I need to see some more follow through and some higher volumes for Qs to rip a little bit higher to 467 in order for me to actually be confirmed that, okay, we're now starting to make actual higher highs and higher lows. There's momentum following through with it. And then the volume is also going to follow through. So those are some key things to keep in mind. Support level is going to stay put at 448, 449. Next target on the Q sits at 467. And coming over to the S&P 500, almost an identical pattern. So you'll notice that this right here, previous high, and we just printed a slightly higher high than the previous time and higher low, of course, for the markets as well. So a little bit of an uptrend now starting to form, but the next target is going to be all the way up to 5,400 to as much as 5,563 on the S&P 500. And again, I want to see more momentum and more confirmation, more follow through on this pattern here in order for me to feel more confident that we are indeed reversing that trend and we're on our way potentially to back to all-time highs. So that's where we are with the higher highs and the higher lows here. The playbook doesn't change. And again, I want to be very clear with my messaging here. Don't want to confuse anyone. We are buying. I am sending out alerts. I did pick up over $30,000 worth of stocks. Most of my buying was on Monday morning at pre-market when the VIX was at over 65. So those are some things that we are going to continue to do. I will continue to dollar cost average when I see those opportunities, whether it's ETFs or stocks or options or index funds or whatnot. I will continue to buy, but I'm not going to be spending to a point where I'm absolutely going crazy, right? This is not a level where I would see myself going all in. So just to give you a bit of a perspective, come over to the MoneyVest Index. These are still light buys and nibble buys for this area. If it dips below 3 and, between 2.4 and 3, that becomes a bit more on the heavy buy side, right? Becomes a little bit, okay, so I can start being more aggressive and more heavy in the markets in terms of dollar cost averaging and start deploying cash. And then, of course, below 2.4 down to as low as 2 is when I start to feel like, okay, it's no-brainer buying opportunities. It's just a level where we haven't come down to that level in a very, very long time. In fact, the last time was September 2022, October 2022, during the end, towards the end of that bear market. And prior to that was June of 2022. And of course, prior to that was the crash, the COVID crash of March of 2020. Anything under 2, and we're really just talking like no-brainer buying opportunities for the market. So we never really dipped inside this green rectangle. And despite that, I still did some buying, as one should, in my opinion, considering the markets were still giving us opportunities and volatility was so high. So just patience. Patience is the key to long-term success, in my opinion. I think let the prices come to you. That's been one of our many mottos on the channel. And again, patience is a virtue. That's what's going to win out over the long term. And as Warren Buffett is very, very smartly put, the stock market is a device of transferring wealth from the impatient to the patient. So if you are patient enough, if you can survive the game, preserve capital, and be in this game long enough, the odds are going to fall in your favor. They're going to give you opportunities to dollar cost average into, and that's what's going to make all the difference over the long term. So coming back over to individual stocks, starting with Apple, and Apple here also pushing higher up over 1.3%. So if you come over to the 30-minute time frame, we identified a little bit of a rising wedge for Apple that in my opinion does still continue to some extent. The next resistance is going to be all the way up to $220. So this right here is going to be that resistance to watch, flat after hours. Support level is going to turn back into 215. So this right here is going to be that level to keep in mind as a support for Apple. And we're still very much nicely making higher highs and higher lows at the moment. Amazon, on the other hand, battling that support here at 166. So you can see that low for the day, 165.85. So that right there is going to be that support level to watch for Amazon. Resistance all the way up to 173 for the stock here. Nice little 69 basis point rebound on Apple. Amazon. Tesla here still moving sideways, consolidating at the moment, up over 0.5%. Next resistance and target's going to be all the way up to $208 a share. So that right there is going to be that level. But of course, we've been consolidating sideways for quite some time. So this right here is going to be a lot of consolidation for Tesla. Resistance all the way up to $203. Support level is going to stay put at $192 for Tesla as well. So a lot of consolidation sideways in that range. Coming over to NVIDIA. And NVIDIA here never really dipped down to... actually did down to $90, but never really dipped down to sub 90. I had a cash secured put at $90. So it was out of the money by 69 cents. What are the odds? What are the odds that I have a cash secured put at a $90 strike and it doesn't get in the money, stays out of the money on Monday morning by 69 cents? Absolutely wild. You just can't make this stuff up. This right here is a downtrending channel on NVIDIA still. Support level is going to stay put roughly at around $96, and we've got I would say a reasonable resistance from a horizontal perspective. It's going to be sitting roughly at $108. And then of course we've got a lower high that's also coming in. So we've got a pretty significant confluence of resistance here for NVIDIA, sitting somewhere between that lower high and that horizontal resistance at $108 per share. But we're still within the context of what I believe to be a bit of a downtrending channel of lower highs and lower lows. Coming over to PayPal and Visa, before we get there, Advanced Micro Devices is the one that we're talking about. AMD here down about 1.5%. Resistance is going to stay put all the way up to $145 to $150, with a support level that's staying put at $130 for Advanced Micro Devices. So it's come down quite nicely. RSI, MACD, L3 banker oscillator, everything's really oversold. So resistance is going to stay put at $148 to as much as $150. Support level of $130. Talking about PayPal. And PayPal here also pushing up 68 basis points, coming up to that resistance all the way up to $68 a share. A lot of consolidation sideways inside this green rectangle. And support level is going to stay put at $56 for PayPal, as we've already discussed. So still within the context of this consolidation inside this green rectangle. And we've got a double triple top for PayPal. Visa in a bit of a downtrend still, very similar to NVIDIA. Support level is going to stay put roughly around $252 for Visa, with a resistance all the way up to as much as $270. So this right here is going to be that level of resistance to watch for Visa. And like I said, support level at close to $252. Talking about Netflix, and Netflix here also pushing up 0.5%, coming back up to its resistance. So this right here is going to be that level to keep in mind as an area of supply and a resistance for Netflix. And support level is going to stay put roughly under $600 a share for Netflix as well. Coming over to Microsoft and Google. So Microsoft here still within the context of a downtrend. I did pick up both Microsoft and Google, I believe on Wednesday, picked up some shares. And again, support level, very, very strong area of demand here for Google, somewhere between 390s and 400s. Very, very oversold. So I do believe that Google makes for a very nice trade at these levels, and resistance is going to be all the way up to as much as $432 for Microsoft as well. And then of course, same situation with Google, considering that it was up almost 1%. Very strong support and area of demand in the 150s. This right here is going to be that red rectangle as an area of resistance. A breakout above that is going to put us on the map to getting up to $174. That's going to be that next level to watch for Google. And finally, we got Enphase and Costco. And Enphase here essentially flat on the day. Just been trading in this consolidated pattern. Massive support in the $92, $93 range, and a resistance up to as much as $138. And this right here is the consolidation for Enphase at the moment. And last but not least, we got Costco. And Costco here with a very nice breakout above that $839, $840 level, up over 1.8, almost 2%. So this right here was that resistance. And that next resistance and target is going to be all the way up to almost $900 per share for Costco. So hope you all enjoyed this video and a complete update on the markets. I got to be honest that in terms of the technicals, yes, we are making higher highs and higher lows. So there is some signs of that trend reversal now starting to show up. Volatility is back down in the normal zone in the low 20s, and that puts us in the 60 percentile range. Valuation once again moving a little bit higher, getting a bit more on the expensive side if you compare that to the historical averages. We are still oversold. We're still oversold on the technicals for the RSI, the MACD. So this is still a market which you could argue is worth taking long trades on, dollar cost averaging a little bit. But remember, the S&P 500 is only really 6% away from its all-time high, so that's still not a pretty big sell-off not at least not big enough for me to be super aggressive in this market. I did some buying today, as I mentioned to you guys over the weekend, that I will be doing a lot of buying this week. Had it been a pretty brutal week in terms of the red to continue, I remember talking about this in my last weekend's video, that I could see the next week, which is this week, being the week where I dollar cost average the most. I become more aggressive and I buy a lot. Most of my buying could possibly be done this week. And I did do buying on Monday and Wednesday, but the markets didn't really sell off more on Thursday, Friday. In fact, if anything, they rebounded a little bit to push higher. So had it been the other way around, had it been a continued sell-off throughout the week and we closed really down significantly, I could have seen myself buying a lot more. But in my opinion, I think keep that strategy consistent. Like if you are a long-term investor, I think it's really important to have a plan in place where you are consistently dollar cost averaging into the market. Don't really pay too much attention to what's going on with regards to all the noise around the markets, but really just focus on long-term vision. I think that's really what we try to cover here on the channel, is that if you are invested for the long term, we're talking 5, 10, 15, 20 years out, the probability for success is really high. We've talked about the distribution of returns over the last almost 200 years for the S&P 500, and it's been a very, very successful pattern and a strategy to keep investing long term, trusting the process, sticking to the plan. And I think that's really important at the end of the day for you to focus on. Yes, dial up on your aggressiveness, on your buying, on your dollar cost averaging once the markets are giving you that opportunity. So don't hold back, just strike your buy orders. But of course, the opposite is also true, right? Restraint, patience, let the prices come to you. I think we have to practice both sides of that investing journey so that we can actually be successful long term. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like and subscribe to the channel. Again, links to our Discord and Patreon is going to be down below. We'd love to have you on board. If you have any questions, please feel free to reach out. There is a 16% annual discount that expires at the end of this month. And as always, happy investing. I'll see you all in the next video.